Okay, let's jump right into this. Welcome to This Explainer. If you're a Canadian sole proprietor, a freelancer, or running any kind of unincorporated small business, this one is for you. Today, we're tackling a topic that honestly usually brings on a heavy sense of dread, but it absolutely does not have to. We're talking about year-end. And our goal today is to completely flip how you look at it. We want to take it from being this frantic, panic-induced last-minute cleanup exercise and turn it into something calm, structured, and totally predictable. Right off the bat, year-end becomes stressful when records are incomplete, inconsistent, or unclear. It sounds so simple, right? But it perfectly hits the nail on the head. Think about it. Most of the stress you feel around tax time, it doesn't actually happen in March or April. Not really. That stress is quietly building up gradually, week by week, all year long. Every time a receipt goes missing, or a transaction gets ignored, or an expense is left uncategorized. That tax time anxiety is really just the compounding interest of delayed decisions. So let's instantly lower the stakes here. Seriously, take a deep breath. If you're a sole proprietor, year-end is not about formal, heavy corporate reporting. You aren't filing some massive T2 corporate return. For you, year-end simply means having your income, your expenses, your GST/HST records, and your owner activity organized. That's it. It's just about getting your data ready so your T2125 form can be prepared and professionally reviewed. Section 1. Consistency over cleanup. This is the absolute core of the Built to Thrive method. A clean year-end isn't some miraculous event. It's really just the natural result of small, consistent actions repeated over time. We all know the old, painful method, rebuilding the entire year from scratch. You know the drill, right? Staring at a shoebox full of receipts smelling like old coffee in panic, basically ruining your weekend trying to remember what a random charge from 8 months ago was for. But then there's the mature approach, reviewing and confirming. When you keep your records up to date throughout the year, tax time is literally just a process of confirming information that's already sitting right there in your system. So how do we actually get there? Let's walk through the 5 readiness steps for sole proprietors. Now, if you're using or getting ready to use the full Sole Proprietor Financials Workbook, you'll see how it actively supports this calm approach. It keeps your transaction entries, adjustments, GST/HST tracking, and tax prep views fully connected. Think of this as your high-level roadmap. These 5 steps naturally guide you from raw daily data to a state where everything is fully prepared and completely ready to hand off. We'll start with source records, handle the tricky mixed-use stuff, adjust for timing differences, review sales tax, and finish with the views your accountant is absolutely going to love. Let's dive in. Okay, step 1 is the foundation. Keep the source records complete. In your workbook, you'll use the annotated bank statement for all your ordinary bank and credit card activity. And annotating isn't fancy, it just means adding a quick little note answering what happened and why was it business related. Then you use the expense adjustment sheet. This is absolutely critical for capturing those owner-paid expenses, reimbursements, or other items that didn't go through the business bank account but really need to be visible before year-end so you don't miss out on valid deductions. Moving right along to step 2. Review owner-paid and mixed-use items. Look, as a sole proprietor, the line between business and personal can sometimes get a little blurry, right? Especially with things like your home office or your vehicle. So the crucial move here is to review those owner draws, contributions, and mixed-use costs now. Use the home office and vehicle use allocation calculator in the workbook to back up your business use estimates. Nailing down your exact business mileage percentage or your home office square footage early, that means you won't leave thousands of dollars of valid deductions on the table when you finally file. Next up is step 3. Capture year-end timing differences. Sometimes the actual cash leaving your bank account doesn't perfectly match the business activity for that specific year. The year-end accruals sheet elegantly captures these little timing hiccups. This is where you jot down income you've earned but haven't actually been paid for yet, or maybe expenses you've incurred but haven't paid, or even prepaid expenses like an annual software subscription. Doing this ensures your records reflect the true reality of your business year, not just whatever your bank balance says on December 31st. Step 4 is a huge one for your peace of mind. Review GST/HST before the filing pressure builds. If you're registered and collecting GST or HST, you need to review the amounts you've collected against what you've paid on eligible business expenses, your input tax credits or ITCs. Knocking this out early gives you your estimated net GST/HST position. And let me tell you, it completely removes the anxiety of a looming filing deadline because you already know exactly what you owe or what you're getting back. Oh, and if you need a quick refresher on how those elements work, definitely check out our other explainers on Input Tax Credits Explained and GST/HST Filing Frequency Explained. And finally, step 5, use the review views for handoff. Because you've been doing the first 4 steps consistently all year, the workbook just automatically translates your daily records into these clear, beautifully reviewable summaries. You get a business health snapshot, your financial position, and crucially, the T2125 reference summary and audit trail. These make your year-end numbers incredibly easy to review, explain, and just simply hand off to a professional. Section 3, hitting good enough. And remember, perfection is not the goal here. The real goal? Psychological safety and financial clarity. We just want to hit a realistic benchmark where your business is secure and you can actually sleep at night. Year-end readiness is working when your bank accounts are reconciled, your GST is verified, major purchases are identified, and your receipts are easily located. To help you hit this benchmark, you can grab the year-end readiness checklist for sole proprietors down in the description. Ultimately, your goal is just handing your accountant a clean file. Because when you do that, you aren't just saving stress, you are literally saving on accounting fees. Your accountant can actually spend their time giving you valuable business advice instead of just doing basic bookkeeping cleanup. Now, it's also really important to clearly define the workbook boundary. The tools we're talking about are highly effective, but you have to know where they stop. The workbook supports your tracking, your review, your reconciliation, and your preparation. It is an educational tool. It does not replace official CRA filing, it isn't tax software, and it definitely doesn't replace professional validation or legal and accounting advice. Think of it like this: it gets you right to the starting line of tax season in absolutely pristine condition. Section 4, reaching sole proprietor maturity. Let's talk about upgrading your systems. By actually implementing these steps, you aren't just surviving tax season anymore, you are fundamentally upgrading your financial systems. In the Built to Thrive methodology, a resilient business is built on 4 connected domains. And by achieving year-end readiness, you are massively strengthening that top right quadrant, tax and financial discipline. You're actively moving away from friction and establishing the kind of rock-solid financial records and compliance habits that outlast the hard years. And with that, this explainer completes the sole proprietor learning pathway. You've officially moved through the entire timeline. You started with awareness, really understanding what actually matters to the CRA and to your business. Then you moved into practice, building those repeatable 20-minute monthly habits. And now you've reached maturity, running a fuller, structured financial system that doesn't rely entirely on your memory or a bout of last-minute panic. At the end of the day, year-end stress is almost always the result of inconsistency, not complexity. When your records are maintained throughout the year, year-end stops being a messy cleanup exercise and simply becomes a structured review. You have the tools, you have the roadmap, and now you have the structure to conquer year-end anxiety for good. So I'll leave you with this. What could your business achieve next year if tax time took you 20 minutes instead of an entire weekend? Remember, clarity reduces friction, structure reduces stress.